Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to focus on three key topics just because they're so relevant for today's world and just where things are going. We're going to look at the EIA, we're going to look at exports and OPEC just because they put out their new report, and then a quick geopolitical backdrop as we had an update on the India-China conflict, which we started really talking about in depth back in May. So let's just really jump right in and get into the crude stock build. So, we all know the headline is going to be 1.22 million, but we have to look at the aggregate, including the SPR. So with the SPR, we're at about 3 million barrels of a build, which is going to continue to increase, and it's going to be a little bit different in terms of how it increases. So we've had an increase in imports into Pad 3 as Saudi Arabia crude comes onshore, but we also have a new resurgence or new shut-ins coming back online. So far we have 60,000 barrels coming back from the Bakken. We have about 500,000 barrels that were shut in due to the hurricane coming back online from the Gulf of Mexico. And we have about another 500,000 from the Permian. So that's why when you look at the crude oil drop, the EIA has us at about 10.5, which is probably accurate right now, but we're going to start to see that come back. Conoco also came out and announced that they're going to bring 100,000 barrels of crude back online coming down from Alaska in July. So we're going to get this slow increase in terms of just production coming back online, but it's going to be offset by less Saudi imports, just as prices have kind of pushed themselves out, as we've only right now, I think, only purchased about one cargo. So we'll talk about that a bit more just because it's an interesting shift as we go forward. And we really need to dig in and look at, okay, well, let's look at this on historics. We still remain near the all-time highs. You can see that we're starting, the pace is kind of leveling off. But again, this is something where we're going to set new records on a seasonally adjusted basis as we go forward. And it's going to remain driven by Pad 3. So Pad 3 is where a lot of this oil is being pushed in, and it's really coming because we have a slowdown in exports and we have additional imports. And if you're in the Permian, if you're in the Eagle Ford, if you're in the Gulf of Mexico, again, this is where everything kind of dumps in. So even as we have imports declining, we're still going to have a new resurgence, which is going to keep us well supplied in Pad 3 at this point. So now that we've talked about this a little bit in terms of imports, exports, let's really dig into the numbers because the imports is really where things are driving. Now, as we said last week, the pace of imports was going to slow into Pad 3 while maintaining a year-over-year increase. And this just, again, it's just timing. Like there's only so fast you can get crude off a boat into either a lightering ship or, there's a certain amount of pump stations that have to be used. So there's always going to be a timing issue. The Midwest is interesting because we've actually gone back to a closer to normal on Canadian imports. So this is something to watch as we have additional Canadian flow coming down, which would also kind of help offset some of this loss from Saudi Arabia. But again, we're a little bit over halfway through the importing process. So we still have more Saudi crude out there, but it continues to come down. Now, crude runs, we're right there. We thought we were going to have a little bit of a decline. Instead, we had a little bit of an increase. But again, we're within our 70% to 75% range. We had some untimed takedowns, which just means that a system had to come offline. And that's just going to take what's happening right now down a little bit. But again, we're going to kind of hang within this realm, with Pad 3 probably coming back a little bit. But again, it's kind of where we are. Now, the implied demand is interesting because implied demand is showing that we're getting closer to normal, where we're only about 3.5 million barrels off of historics. Now, this is a calculated number. We have to look at all aspects. And distillate had a nice increase, and the increase is still being driven by the exports that we had. going into Europe, but also we have jet fuel being preserved again. Jet fuel, while there's still obviously a glut, not as many people are driving, but now that there's a little bit more of a demand, you're seeing some of that jet fuel that was going straight into distillate being pulled out and kept separate. So this is going to kind of create a weird backdrop as things kind of normalize. But when we look at industrial production, we look at shipping data, CAS index, there's still, we still see a big drop in terms of just diesel demand, with Europe averaging anywhere between 20% and 30% below normal on diesel, gasoline, and the same can be said for India. So we're kind of within this normal range, which we think is going to be relatively difficult to kind of break out of, just as the economies continue to struggle. Now, when we talked about imports, you can kind of see how we had that huge surge as these ships came in, started to line up. But again, we're starting to come back down into more of a normalized level when we're considering where storage is offshore. And again, like most of the vessels are already there. So it's not like we have a lot in transit that is, waiting to show up. So this is a relatively true number, which we're starting to kind of get back down to those normal levels, which it's not so much good for pricing. It's just a matter of we're starting to realize a lot of these gains, and they're going to appear in the PADD 3 storage numbers. Now, the oil import number is important because this is, again, where all of this is really going to sit. So we're kind of right at these averages. We were well below, obviously, because the world was going to hell in a handbasket. But now that things are starting to normalize a bit, you're kind of seeing that we're going to sit around this normal level. And again, it's going to ebb and flow, but we're going to kind of hold that average as we go through the rest of June. The bigger issue is always demand. And when you look at demand, the largest buyers of oil are always going to be refiners. So when you look at where we sit, again, the pace remains painfully slow. And we're seeing this across the board. This is a Singapore issue. This is a European issue. This is an Asian issue. Asia's starting to come back a little bit. You have India that has taken some assets to 80%. But China is actually on the downswing. You had teapots that, or the independents that reached 76% and is moving back down to about 65%, where the average within China is about 70. So again, the 70 is kind of that number that seems to make everybody comfortable. And it's because we have so much global product that has to be moved through the system before you can really re-engage your refiners. Now, we've talked about the distillate and the gasoline numbers, but it's important to put it into context. So when we look at distillate going back to 1991, you can kind of see we're right at the average. So even though we've had a nice bounce, we're not seeing anything really significant. It's just a matter, we had that we came off of that seasonal low, and now we're kind of sitting in numbers that we've seen back going to the early 2000s. So again, not something that is something to get excited about, but at the same time, it's showing there is a little bit of movement. But we're going to have to see how this continues to play out as jet fuel gets pulled out, and you get this conflicting data in terms of that industrial production, which remains very low, and just the supply chain on trucking, shipping, and rail, which remain lackluster. The bigger thing that people have pointed to is really on the demand side, looking at gasoline. So when we look at the retail consumer, our view is that we were going to get to that kind of 8 million barrels a day and level off. And, here we are. We're right at about 7.87, waffling back around. And you can see that we've hit a little bit of a plateau. And that plateau is going to be relatively sticky, only because as New York and New Jersey are coming out of the lockdown, where some places are in phase 2, some are already moving into phase 3, you're getting a counteract in terms of Florida, Texas, and Arizona seeing an increase in COVID cases and things starting to slow down a little bit. Now, the reason why that matters is because you're consuming more gasoline in those regions because you're driving more miles, and just you have to think about density. How far do you drive to the store? It's going to be vastly different between the Northeast and the South. So that's why there's kind of a mix in data, which is why we're pretty comfortable saying that that 8 million barrels is going to be a relatively sticky number as we go through essentially into July 4th. Now, the gasoline data, we like to look at a basket of information, whether it be Google, Apple, and Gas Buddy. And this helps you put into context where we sit. Again, like over last week, after last month, we continue to see a resurgence in just consumption. People are driving more, people feel better about the economy, people feel better about getting out of the house. But again, you have to think about what it was last year. And right now we're averaging about 20% versus last year. And as we go closer to July 4th, which is another surge in vacations, driving, that'll be another test of how comfortable do people feel driving for a holiday. We saw that Memorial Day was very weak, or at least weak on a seasonally adjusted basis. And, July 4th is going to be another test where we'll be able to kind of see where things are going as we, finish out the year or the driving season. Now that we've gone through some of these different aspects, on a high level, let's dig in a little bit to crude exports and just U.S. exports. So when we look at, what's been happening throughout the U.S., you can kind of see that, gasoline exports have started to increase a little bit. And again, we're coming off of a huge down move. You have a little bit of a normalization in parts of Latin America. In Brazil, they took down refiners a significant amount, and this is just because of the resurgence or surge really of COVID within the area. So that comes down to workers, demand. So we're getting a little bit of movement, but at the same time, it's also price distinctive because prices got a little bit better. Things started to move a bit. Distillate is one where you can see, even though we slowed down week over week, we're still relatively high in terms of just year over year and 5-year average. So you can see that there's a certain amount of support, which is, again, really kind of factoring into that implied demand because you have the distillate fuel exports pulling down from storage, which is kind of helping things move. And again, jet fuel's starting to normalize a bit. And this is why we're going to talk about it in a little bit more depth as we go forward, just because we have to start thinking about this as flights start to take off, people start to feel a little bit normal about travel. Again, not back anywhere near previous years, but just a little bit normal versus previous. And then the other is crude exports. We talked about kind of holding this 2.5 million barrels a day, and that's something that's going to remain. The market still remains awash with crude in storage, specifically on a floating side. So I don't see us going too much lower, but at the same time, I don't really see any reason, based on our ship tracking and just kind of what we're being told in terms of getting above that 2.7 million number. Now, again, we always have to talk seasonality. So let's talk about, where exports are on a seasonal level when we're looking at gasoline. Again, we're just kind of back to normal, in terms of the averages going back to 2011. And again, like this is something where we're going to pull back a little bit. We had the seasonal bounce that we normally have. When you look at it on the highs and lows, you get a little bit of a pop. Again, this is something that can be price driven, can be just a little bit of a demand surge just coming out of Latin America as they try to backfill because people still are consuming a certain amount. But again, this is something where we don't think we're going to go back to all-time highs or even back really much above average, but, kind of waffle around and start to track a little bit closer. Distillate, you can see here, we still have that spike in. We pulled back, like I said, a little bit, but we're still remaining above that average. Again, this is something that's going to continue to work off as the exports that were sold into Europe start to normalize, start to get filled. And we're going to start to see this normalize to the downside. Again, not going back down to the lows, but again, I think we're going to go back down to what was typically our average. Now, again, it's important to really go into gasoline in a bit more depth because you can see that we still remain, well above average, but it's really being driven the most by PADD 1 or the East Coast. And the East Coast is going to be problematic because this is where imports are typically coming from Europe into the U.S. And just given where we sit in terms of, seasonally all-time highs, it's going to be really hard to see a big increase in terms of imports But at the same time, we have a lot of demand to work off. We were going to require a lot of demand to work off the supply, and it's just not materializing in that level. So we're going to remain in this weird, stickiness in terms of just this oversupply that's going to permeate the system. And again, pad 3 remains there. Pad 5 is kind of back and forth. Pad 3 being the Gulf of Mexico, pad 5 the West Coast. It's going to be tough to see us really get any kind of mobility in the near term. Now, again, the next part is to really go into distillate in a bit more depth. And the reason why it's important is, we all know that we're at all-time highs in terms of storage on any kind of seasonal level. And it's important to see we had a little bit of a draw, but it's here we want to call out production, because you can see the production at the refinery level is down. Now, this is due to the fact that we're well awash with distillate in storage, but you also have jet fuel being pulled out to some degree. So like we talked about in the past, kerosene or jet fuel can be put into either distillate or gasoline. And now that we have a little bit of a gasoline pull, we're having a little bit of a benefit in terms of where jet fuel demand is going. You're starting to see some of that get pulled out of the distillate stream, which is why that production has kind of come down. And it's pretty much across the board. And it's really driven based on remaining lack of demand for diesel, jet fuel coming out, and at the same time, just exports that are starting to slow down as we go through the next couple of weeks. So we've talked about jet fuel, but it's important to really highlight, again, I'm not saying that we're in this huge jet fuel sweep, but we had a little bit of a build, but we're getting closer to normal on a year-over-year level, which is important in terms of where storage is. So the production has started to shift, which just means that refiners are starting to target jet fuel a bit more, which will impact some of the distillate that we've talked about. And when we talk about jet fuel stabilizing, again, going back to 1991, it's stabilizing well below seasonal norms. But again, we're kind of bouncing around at that 788,000 barrel a day level, which is something that we think is relatively sticky. Not so much that it's going to increase, but we don't think we're going to see the lows again, at least in the near term. And when we talk about the lows, again, we have to talk about the TSA and year over year. So the trend remains positive. We're still going up. We always have those ebbs and flows as we go through. But again, we're going to sit between that kind of 480 to 800,000 passengers. Again, well off the average of 2.5, but it's still getting to the point where we're going to kind of maintain these levels. And just in terms of where COVID sits, we have commentary from airlines that they're starting to bring back more flights. But then at the same time within Beijing, you have in China, you have flights being you have flights being pulled off. So you're going to go back and forth. So, there's going to be ebbs and flows on a global level when we're looking at jet fuel. And that's going to be a focus as we go forward and start to look at jet fuel as its own product. And then if shipping starts to recover, we'll start to look at bunker fuel and get really in depth. But these are where we think the big focus is right now. Now that we've gone through some of these products, it's always good to look at it on a global perspective. So when we turn to our typical USA, Japan, Fujairah, you can see that we continue to grind higher. And again, this is right now is really being driven by US and mostly Japan. Japan had a big increase. US had an increase, but a little bit smaller once we add in crude and distillate. And Fujairah was a little bit down. Again, they kind of peter out, and then we might see another resurgence. But it's good to see that the pace is slowing, but again, it's still increasing. So the last time this happened, then Fujairah had a big increase. So this is something to watch as we go forward, because Fujairah is going to be a better indication in terms of what does shipping look like, what's happening in the Middle East and Asia, and then U.S. and Japan is obviously continuation of where things sit. And then some other little data point is really just looking at crude storage in the ARA, which is again just Europe. It was down about 5.2%, and it's still above the seasonal average as we going back to 1991, but still nothing too aggressive. Like there's still an increase. There's still a significant amount of crude sitting on the water, which is going to remain a bigger issue as we continue to try to find some sort of normalcy. Now, OPEC and EIA put out some of their numbers, and it's always important to appreciate, where does OPEC sit? And you can see that the main numbers that they have are about 24.1 to about 24.2 million. Now, it might sound good, given where April sat, but again, this is still showing non-compliance. And this is even with the GCC main countries of Saudi, UAE, and Kuwait essentially taking the lion's share. Now, we know that that's only going to remain through June, and then some of the additional voluntary cuts are going to get erased. Iraq remains the biggest non-compliant. They came in at about 4.16. They should be at about 3.55. So again, there's this misconception in terms of, well, it's better that they're going down, but at the same time, we still have little demand at the refinery level. They increased official selling prices, so there's less margin for the actual refiner, and there's still a significant amount of crude on the water. So while this looks good, they're enabling some of this crude to go from storage on floating storage onto on-land storage, but we still have this disconnect in terms of where we sit, given the massive oversupply on a refined product level as well. So when we go through and say, okay, well, you keep talking about, where are the builds? And that's when we look at the OECD countries, and we can see that the build really accelerated and is now at a new historical high. And this is, again, just seasonally adjusted, just kind of appreciating where we are in April. May is going to continue to be higher, just given kind of where we sit as the crude comes into the market. And we're at about 3.1 billion barrels. So you can kind of get an idea of, how big this really is. And when you think about the full supply chain, you have to work through the product in order to pull down more crude from storage, and then you're going to go out and buy more crude. So the whole supply chain remains oversupplied, and there's still a significant headwind as we go through demand over the next couple of weeks, given just kind of where COVID sits and where people feel comfortable. And just, again, unemployment on a global level remains a huge problem, which is going to impact consumer demand. So when we talk about China, we've talked about floating storage hitting all-time highs, and it continues to surge higher. We showed some pictures last week in terms of boats sitting in off the coast of China, and here you can see, just based on the Clipper data, it still remains at all-time highs. And this is something where, again, it's on an Asian level. Like China is obviously a big component to it, but this is also the case in Japan, South Korea, and India. So while everyone is coming out and saying, well, China's back to normal, it's like, okay, well, they took advantage of pricing. They then said, okay, well, pricing, the average price in May and through May was $27.08. We're currently sitting at about $40 on a Brent level. So they took advantage of pricing, and now they can sit there and say, okay, well, we have all of this oil in storage. We really don't need to go to market. So this is the biggest issue that happens in the energy world is, everyone assumes China's back. China's going to continue to buy at this level. And that's just not the case. Like, they're going to play the system and they're going to play the game of trying to get the best price possible. And they also have their own demand issues. As we go forward, we have to remain vigilant on COVID and a potential for a second wave, or, if the first wave never really ended, is it just a resurgence of the first wave? But this is just a data point. Johns Hopkins does a great job of collecting the data on a county level within the US. And then official numbers, take them for what they are, but it is kind of a semblance of an idea of where things sit. We've had a resurgence in the US, as we've talked about in the South. Latin America continues to add new cases. And China, again, Beijing has gone into a level 2 lockdown, which is interesting just given, they said that there's 100 people, 100 people, how many zeros did they erase? But again, irregardless, you're getting a shutdown in Beijing. We've talked about 3 different provinces within the north that have seen a resurgence of COVID, which has had some sort of lockdowns, and Beijing is getting another one. They're cutting about 2,100 flights out of Beijing. They're telling people to stay home. They're closing schools. So again, like this is a clear demand problem that is going to continue to resurge. But the other important chart is that bottom right one where you look at the yellow one. We still haven't peaked. We still continue to grow on a confirmed level on a global basis. So this is something to watch as we continue to go through, specifically in the US, as things start to reopen, people start to feel a little bit more normal. We're going to have to be vigilant. But again, it's more the hospitalizations because we've learned more. We've learned how to treat it better, how to focus on this. So this is something where utilizations of hospitals will be key. Now, just to round out, just because it's something that we've talked a lot about, is the India and China impacts. India and China, given there's always been conflict in this region. There's always been, pushing and shoving. The most recent conflict was in 2017. It's happened in the Doklam Plateau on Sitka, as we go further over. But here we had an actual deaths. Right now we know that about 20 Indian soldiers were killed and about 43 Chinese soldiers. So the casualties are there. It's right in the line of actual control in Ladakh. And this is something that we have to focus on. Now, while Modi and Xi has said de-escalation, there's still a huge amount of animosity between these two nations. They both have the largest, between the two of them, they're about 2.7 billion people, and they're getting more and more nationalistic. And you have to think of economies are struggling for both of them. Water, food is becoming a problem. COVID is ravaged both countries, both economies, and realistically, India can say, well, it's China's fault. And China can say, well, even though it was our fault, we tried. And there's going to be this animosity. And again, we flag this not because it's going to lead to World War III, but you have two nuclear powers that are now getting more nationalistic and are actually killing each other's soldiers. So again, this is something we're going to be focusing on because it does involve water. It involves a plateau that can actually get heavy machinery across the border and across the Himalayas. And when you have two powers building infrastructure on either side of a disputed line, specifically the line of actual control, there's going to be problems which we have to focus on. So now that we've covered the EIA, OPEC, and then some global data, on Friday, we're going to have a shortened show in honor of Juneteenth, and we're going to focus, primarily on the primary vision frac spread count. We'll do a little bit of color around what that is, where things have gone, but expect a shorter show. And next week, we're going to resume our normal shows between the EIA and primary vision frac spread count. So I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Thanks again for watching.